Hi everybody and welcome to my channel. In this video we are coming to look at business valuation, and we are basically coming to explore the popular methods of business valuation that we have. And so let's get right into it. So the focus of this video is we are coming to look at the meaning of business valuation, and then the why do we have to value businesses, and then we'll look at the valuation methods that we have. Okay, so what is the meaning of business valuation? Business valuation is simply putting value on your business. So it means business valuation, valuing your business. So we are basically trying to put a value on our business. If we are to sell our business today, how much will it cost? If we want to do a capital reconstruction or something, how much is our business worth? That is what we call business valuation. So we are basically looking at the equity, the market value of the equity of the business today. That is all we are looking at. So that's the meaning of business valuation. And the reasons why we value businesses, there are many reasons why we value businesses. We value business, number one, to determine the value of a private company, because private companies are not listed, and so we want to know their value at a particular point in time. Perhaps there is going to be a management buyout, and when we talk about management buyout, we are talking about um, the current management of the business buying the business they are managing. So that is what we call management buyout. Then there is another one called management buy-in, where um, external management comes in, or let me say external investors comes in to buy the business and then they manage it. So that is what we call management buy-in. Management buyout is where existing management buys the business and manages it. So that is the difference. And then we also value businesses to determine the maximum price to pay for a listed company. So when a business is listed, we want to know how much um, value we can sell the business at, the maximum price possible. And then also, another main reason is to know the value of the business, so that if he wants to trade on the stock exchange for the first time, also known as initial public offering, we can know how much the share of that business that wants to get listed should cost or should sell. Alright, so those are some of the main reasons. Now let's go to the methods of valuing businesses. So there are three main categories of valuing businesses. We have the asset-based method, or what we call the uh, the asset-based method, and then we also have the earnings or income-based methods, and then lastly we have the dividend-based methods. Now there is a fourth one which we call the cash flow models, where we look at the cash flow to the firm, and then cash flows itself. So we are going to cover those in another video because they are quite extensive and they stand out. So in this video we are just coming to introduce them, perhaps talk about them a little. However, they are going to be covered extensively in other videos. Alright, so the first one we are looking at is the asset-based method. Now the asset-based method usually depends on the historical financial statements, and we are specifically looking at the statement of financial position. So the value of the assets on the statements of financial position is what we use to value the business, and that is what we call the asset-based method. So there are various types of the asset-based method. However, depending on the type you are using, they all use the same principle, and the principle is dependent on the basic accounting equation. which we know to be assets equals equity plus liabilities. So this is the basic accounting equation, and this particular um, method of valuing businesses depends on the accounting equation. Now, we want to value the business, so we are looking at the value of the equity, how much we own in the business, the amount we own in the business, the worth of that amount. So we are looking at the worth of the equity of the business. So business valuation is talking about placing value on the equity stake of the business. That is basically what you are looking at. And so we have to make the equity of this equation the subject, so that we will know how much the equity costs. And so to do that, we know from basic mathematics it's going to be equity. So this is x. So if I input equal to sign, it's going to see it as a formula, and so it will give me an error. And so what I will do is I'll just type it straightforward. So we have equity, so I'm making the equities in the subject, and that will be equal to our assets. It's going to be our assets minus our liabilities. So this is the formula we use to determine the value of the business under the asset-based method. So whether we are using the book value, which we have here, or we are using a replacement cost or the break up basis, we are using the same equation. Equity equals assets minus liabilities. So there are various reasons why we might use the book value of the business, replacement costs, a breakup value, or the also known as the net realizable value. So with the book value, we want to know using a book value, we want to know the business's value at a particular point in time. So we know that the balance sheet or the statement of financial position gives a snapshot of the assets and liabilities of the business at a particular point in time. So with this method, we are just looking at the value of the business at a particular point in time, just as the balance sheet presents it. And so at the end of the day, we are going to have the value of the business equal to the equity value on the statement of financial position. So that is easy and straightforward. Now, the replacement cost is another. Now, the book value method has some limitations because it is dependent on the historical costs of the assets of the business. So that is a limitation, and also the book value method ignores certain relevant items on the balance sheet, such as internally generated goodwill, which can be valuable to the business, or which is actually valuable to the business, but it is ignored. And also the carrying amount or the carrying value of the assets, especially for PPE or the property, plants and equipment, are actually subjective, in that they are subjected to depreciation and amortization, which are very subjective. So those are some of the shortfalls of the book value method, and so the replacement cost comes to correct those shortfalls of the book value method. So with the replacement cost, an external valuer comes to value the business, and then they place value on the various components of assets and liabilities that we have on our balance sheet. So instead of using the book value or the carrying amount of the assets on the balance sheet, we use a replacement cost. So that is the replacement cost method. And the replacement cost method can give you the maximum amount we want to sell a business in case we are valuing the business for sale purposes. So that is the purpose for the replacement cost. And then we also have a third one called the breakup basis, or the net realizable value. So the net realizable value has been defined, the NRV, as defined by IAS2 inventories, or what we call the net realizable value, is defined by IAS2 inventories as the estimated selling price, in the ordinary course of business less the estimated costs of completion and the estimated costs to make the sale. So all that we are saying is that NRV is the estimated selling price of an asset less any cost we incurred in making the asset available for sale and any costs we incur in actually making the sale. So that is the meaning of NRV. So it is also another method of valuing businesses. And as we have seen in the definition of NRV, this particular method comes in when the business is folding up, when the business wants to fold up. And so another word or another term for the breakup basis or the NRV is also called the liquidation method. The liquidation method. So we are trying to liquidate the business, and so we want to know how much it will cost us to sell the business and any other selling costs that we may incur making the sale. So that is when we use the NRV or the breakup basis method of valuation. So that is it that we have here. And the second category of valuation methods we have is the income based methods. Now this is where my focus is going to be in this video. So the first one we are looking at is the price earnings multiple, or the price earnings ratio, also known as the PE ratio. The PE ratio. Now with the PE ratio, this ratio is an indication of the potential growth in the share price of the business. So to calculate the PE ratio, what we do is we take what we call the market price per share of the business, the market price per share. So the share of the business over the earnings per share. So as we did for our assets, we are looking at the value of the business, and the value of the business is seen in the share price of the business. And so with this formula, we are coming to make MPS, or the market price per share, as the subject, because that is what we are interested in. That is what we are trying to value. So we are trying to value the MPS, or the market price per share of the company. So we are coming to make the market price the subject of the equation. So to do that, we'll have MPS being equal to the PE ratio. So it's going to be the PE ratio multiplied, so we have PE ratio multiplied by the earnings per share. So this is the formula we use to value the business. Now the earnings per share is our total earnings after tax and dividend. So it is the total earnings after tax and dividend divided by our total number of shares. That is how we calculate our EPS. So let me just write it here. So we have EPS being equal to our total profits after tax divided by our total number of shares. So our total number of shares. There we have it. So this is how we calculate the EPS. Now, as I said earlier, we are coming to actually apply this in in a business question, and so we will see how actually this is going to be applied in a real case, a business case. All right, so that is just a brief um, look at the price earnings ratio. Now, the price earnings ratio is a very important of um, indicator that investors usually look at when they want to invest in a particular business. So it is a very key concept, or it's a very key method of business valuation that you shouldn't joke with, and it comes in the exams a lot. So if you want to master business valuation methods, you need to actually learn price earnings ratio, and the P ratio both indicates the current position of the business as well as its future growth potentials or prospects. So that is what the PE ratio. So it's very key, it's very important in investment decision making. So whenever you want to invest in a business, you have to look at the PE ratio and see how much or what the PE ratio is, and then you make your decision accordingly. So in general, if the P/E ratio is high, it is an indicator that, or it is an indication that the share price reflects good growth prospects. So whenever the P/E ratio is very high, or is high, moderately high, or very high, it means the result a very uh, good growth prospect for the business. And the opposite is true for lower P/E ratios. Now you know this low or high by comparing it with other businesses, the P/E ratio of other businesses or the industry standard. So what we do basically is that we pick the P/E ratio of a listed company and adjust it upwards for use by an unlisted company due to the higher risk they face. So that is what we do. We are coming to solve a question. I have a question here we are coming to solve. So make sure you subscribe to the channel and you turn on the notification button so that as and when I release the second video, you can have access and follow along. Alright, so now the second one is the earnings yield. Now the earnings yield is the inverse of the price earnings multiple, or the price earnings ratio, or the PE ratio. So with the PE ratio, we have the MPS being divided by the EPS. With the earnings yield, it is the opposite. So there is the EPS rather divided by the MPS. Now these are not formulas you have to learn by rote. You can actually derive the formula from the name of the valuation method. So for instance, this is the earnings yield. So it's going to be what? Earnings is earnings divided by yield. Now in financial management, whenever you hear about yield in financial management or accounting, whenever you hear about yield, we are talking about the return, and we know that return is usually seen in the price of the shares of a company. So this yield is actually referring to the price of the shares of a company, and that is why we are having the market price per share. The market price per share. So that is what we refer to as this. So the earnings, we are talking about the earnings per share divided by the market price per share. So I'm just giving you a tip so that you don't memorize these formulas by rote, because it's going to it is possible it might escape you in the exams. So just learn to derive the formula from the uh, valuation method. Okay, now the earnings yield, as you have seen, is the opposite of the PE ratio. However, we are calculating for the MPS, and so the MPS, or the market price per share, which is actually the value of the business, is going to be the MPS being equal to our EPS. So we are just changing the subject. We are doing a change of subject. So MPS is equal to the EPS divided by our earnings yield, which is EY. Let me represent that by EY. So let me actually come here so that whenever you see EY, you know that we are referring to the earnings yield. Sorry. So we have that. So that is how we calculate for the NPS. So the earnings yield is talking about the potential amount of earnings we would receive when we are to invest in a particular business, or if you are to buy the business, invest in it, or whatsoever you want to do. So that is what the earnings yield is talking about. How much earnings are we likely to generate in this business after we invest in it? So that is the earnings yield. And for unlisted or unquoted companies, we also assume a risk factor because of the riskiness of unlisted companies. Now, they are risky because, as I said earlier, they are not regulated. So, their shares are also not marketable. And so, they face higher risk. And in finance, there is a positive relationship between risk and return. So, whenever you expect a higher risk, or whenever you are assuming a higher risk in an investment, you expect that the returns should be higher. And so what we do for earnings yield is that we pick the earnings yield of a quoted or a listed company, and then we scale it up by the assumed risk factor. So we can assume a risk of 20%. So if the risk is 20%, we will apply that 20% on the earnings yield of a listed company and add it back. So that is, we are trying to increase the earnings yield of the listed company because of the potential risk we are assuming for the unlisted company. So that is it for the earnings yield. For price earnings, when we assume the risk, we scale the P ratio down for a for an unquoted company. So that is what we do. We assume a risk. So let's say, for example, the risk, or let me say, the P ratio for a particular listed company is always 100%. So it is always 100%, and we may want to assume a risk of, say, 20%. 20%. So what we do is that for an unlisted company, we'll pick the 100%. So I'll pick the 100%, and then I'll subtract 20, and that will give me 80%. So it is the 80% of the PE ratio of the quoted company that I would use for the unquoted company. Why? Because the risk being assumed, or the risk that will be faced by an unquoted company is higher, and so we don't expect that much growth in that business. So we want to factor in the risk, um, the risk. All right, and then when it comes to the earnings yield, this is the opposite of the price earnings, as I indicated earlier. So instead of actually scaling it down, I'm going to scale it up. So I'll pick my 100% and add my 20%, and that will be the earnings yield for my unquoted company. So the 100 represents that of the quoted company, the and the 20 is the risk factor, and so we are increasing the returns, the potential returns on our unquoted company because of the risk that we are trying to assume. Now the dividend yield is equal to the annual dividend per share, or the DPS, divided by the market price per share. So when we pick our dividend per share, as I said earlier, this is dividend yield. So dividend per share divided by the market price per share. The yield is talking about the price of the asset or of the business. So market price per share. All right. So that is it. And so if you want to find the NPS for our um, dividend under the dividend yield, is going to be the dividend per share divided by the dividend yield, which is dy. So it follows the same principle as the earnings yield, and this 120 is going to be used for our dividend yield as well. So if you use 120 for this, we are going to use the same 120 for that. Sorry, so I'm going to copy this and paste it here. Sorry, so this has distorted. So this is equal to 120 plus the 20%. That is 120. Alright, so that is it for these two. Now the dividend is talking about the dividend. We know that shareholders receive returns on their investment in the form of dividend. So the shareholder is basically looking at how much am I to return in dividend if I invest in this business, if I take this investment opportunity, how much return am I going to make in dividend? Okay, so that is the dividend method. And then the last one we are going to look at is the Tobins Q method. The Tobins Q. Now this method was proposed by James Tobin in 1969, and what it measures is it measures the relationship between the market value and the intrinsic value of the business. So the market value is the market cap, what you call the market capitalization. That is the total number of shares of the company multiplied by our the share price. So that is the market cap or the market value of the business, and then the book value of the business. So how much is our market cap and what is the book value? And this is actually expressed in a ratio of 1. So if the market to book ratio is 1, it means that in the long run, um, the value of the business, or the market value of the business, of the equity, is equal to the book value of the net assets of the business. And if you calculate this ratio and that of a company has a ratio of less than 1, then it means that it is more vulnerable to acquisition, as this suggests that it can be acquired more cheaply than acquiring the underlying assets of that business. And if the ratio is greater than 1, it's an indication that the business is overvalued, and so it has an earning rate higher than the replacement cost. So the individual or other companies would create similar types of businesses to capture some of the profits this particular business is reaping. Now this particular method is fairly simple, as we will see in our practice examples. So don't worry, we will look at it further. Alright, then the third category of valuation methods is the dividend based methods. Now we talked about the dividend yield. The dividend yield, don't confuse it with the dividend based methods of valuation. So with the dividend based method of valuation, we are talking about two categories or two methods. We are talking about one, the constant, where there is a constant dividend growth. Where there is a constant dividend, which means that we don't expect any growth in dividend. So we are assuming that the business will grow or the dividend will remain the same over time. So that is one of the methods, and this is calculated by just taking the current dividend per share and then we divide it by the dividend yield. So we divide it by the dividend yield, and the dividend yield, we have already seen it here. So dividend yield is actually the EPS over the NPS. Alright, so that is how we calculate for the the dividend when we expect dividend to be constant over time. And then when we expect a growth in the business or in the dividend, then we use this formula here. And I have broken it down for us. So we have P0 being equal to D0 in brackets 1 plus G, all divided by the return on RE minus the G. Now this is the meaning. The P0 here is representing the price of our ordinary shares. Now dividend is paid to ordinary shareholders. So the P0 here is the price, this is the share price of the dividend. As we can see here, P0 is equal to this, the today's X price dividend. So it's talking about the current share, uh, the current price of the business, and that is what you are trying to value. This is the valuation of the company, of the business. So it's the price, as we have seen in others as MPS. This is the price, and the D0 here is the current year's dividend. Is the current year's dividend, or the most current year dividend. And this one here is a constant. We add our growth rate to it. So the G here is the growth rate. The R subscript E is the return on equity, the required rate of return on equity for the investor. So that's the RE. And then we subtract the growth again, the growth rate. So this is the formula we use. This is a formula, and you just have to find a way of memorizing it. So it is D0, which is the current dividend in brackets, multiplied by 1, which is a constant, plus the growth rate, bracket close. We divide everything by the required rate of return, then we subtract the growth rate from it. So this is how these are the two methods under the dividend based methods of valuation. Alright, so thank you very much for this introductory lecture on business valuation. In my next video, we are coming to look at a practical example of or a past question, and then we will see how we can apply this business valuation in questions. When a question is thrown at you, how do you navigate and use the figures you have in a question to be able to calculate your ratios or your business valuation methods. Alright, so thank you very much, and I'll see you in the next video. If you have not subscribed to the channel, kindly do so, and then also hit the notification button just so you can receive notifications when I release the new video. Alright, so thank you very much and have a lovely day.